It's that time of year again. Investment management companies are all releasing their forecasts and outlooks for the upcoming year. And while these predictions can be intellectually intriguing and no doubt thoughtfully prepared, rarely are they reliable. Recent studies have shown that most market forecasts are incorrect. In fact, a study by CXO Advisory Group found that the average stock market forecast accuracy was just 47%. This means that if you flipped a coin, you'd have a better chance of being right. So if that's the case, what are you supposed to do? You just put up your hands and admit defeat? You buy gold and bury it in the backyard? If even the smartest propeller heads have no idea what the future holds, how can you have any confidence in your own retirement plans? It's a fair question. And so in this video, we'll pull up a report card just to confirm whether or not these market forecasts over the past few years have held up or not, straight A's or needs work. I'll help you understand why the results are what they are, and at the end I'll give you 3 things I think you should do instead to improve your situation. Hey everyone, I'm Steve Willems. I'm a wealth advisor with the Willems Wealth Planning Group out here in BC. We started this channel to give you the tools and insights you need for a successful retirement, from arranging your investments and your income streams, ideally slashing those tax bills along the way. Now, given the prominence of these forecasts, it'd be reasonable to assume that they carry some weight. A quick Google search shows that there's already over 150 million web page results of prophecies of what's to come. But let's take a quick look at just the last 2 years to see how the 2022 and 2023 predictions actually held up. Bloomberg's Jonathan Farrow posted the 2022 year-end stock market forecasts from the big Wall Street firms at the start of 2022. You see, the previous year, 2021, was an incredible bull market, culminating in the meme stock craze of GameStop and AMC, the crypto craze, the housing market craze. Everything was going up. Everything was green. Wall Street, in their collective wisdom, took the annual reading, and these were the forecasts. So looking through it, a high of 5,330 and a low of 4,400. And then here's what actually happened. Not good. 0 for 14. Not a good look. The market over that year pulled back 19.5% in that single year, ended in a bear market, and one of the worst years for balanced portfolios on record. Probably was just an off year. Let's dust ourselves off and try again in 2023, they probably thought. Now, Jonathan did the good work once again and pulled the updated forecasts from everyone for 2023. And here's what he found. So after ending the year with the S&P 500 at 3,839, Wall Street figured the next year would range anywhere between 4,500 and 3,400. Pretty wide range, but most figured pretty average performance for the year, probably given how bad the previous year was. And so as we sit here in the final week of December 2023, here's where we stand. The markets didn't care what everyone thought. They blew past everyone's sour predictions and are on track to end up over 24% higher. And the forecasters? 0 for 18 this time. And even worse, one of them even went bankrupt for that time period. Bankruptcy! Credit Suisse, who couldn't even foresee their own demise. Now, the point of this all isn't to dunk on Wall Street people. It's part of their job, and they're exceedingly skilled at what they do, no doubt. The reason I drag us all through this is to show just how silly it is to think that you have the ability to predict what's going to happen over any 1-year period. And if that's the case, why do we pay so much attention to all of these outlooks anyway? Now, part of it, I think, is human desire for control and understanding. We want to know what the future holds. But the truth is that the future is just highly unpredictable. And often the most notable events in a given year, they tend to come from the tails. Events that are entirely unexpected and no one could have ever predicted. So all of these forecasts and outlooks, if we're honest, they're just educated guesses. They're not a guarantee of what's going to happen in the future. So what are you supposed to do instead? I think there are 3 things that you could do. One of the smartest moves you can make is to build a well-diversified portfolio. Diversification means spreading your investments across multiple asset classes, so stocks, bonds, real estate, maybe even some commodities, but also geography and factor. See, by diversifying across all of these types of investments, they're all naturally going to move at different cadences, different rhythms. Over the long haul, a diversified portfolio has historically smoothed out many of these ups and downs of any single market. No one knows exactly which investments are going to perform the best over any given time frame. So by holding a little bit of everything and holding them in line with your risk preferences, you're going to give yourself the highest probability of hitting your desired goals. And at the end of the day, that's what we're all shooting for anyway. The second thing to do is to learn to tune out the noise. And this is truly a gift. Let's face it, these market forecasts, they're noise. Distracting, often disheartening noise. It's easy to get caught up in the daily market updates, the predictions, the doom and gloom on the one hand, or even the over-optimism on the other. But here's the thing. Tuning out the noise can be incredibly emotionally freeing. It lets you focus on what really matters, your career, your family, your friends, the things that you care about. It's entirely reasonable to still be aware of what's going on, while also fully admitting that much of it is simply noisy entertainment. And I'd suggest if you find yourself getting caught up emotionally in these cycles, suggest you err on the side of turning off the news entirely, not just trying to strike a happy balance. Finally, it's crucial to stay flexible and adaptable. The world is always changing, economically, politically, technologically, and your financial strategy should be able to adapt to these changes. That doesn't mean overreacting to every news headline or market dip, but it does mean having regular check-ins with your financial plan and adjusting as your life circumstances change. See, over the past 2 or 3 years, there have been specific opportunities that have shown up as the market did its thing. Back in the summer of 2022 was a great time to deregister some RSPs and reposition some of those values into TFSAs so that when the recovery started, you're not growing a long-term tax liability. And at the end of 2022, it was a great time to look at tax loss harvesting. By the end of this year, we're now looking at donations of appreciated securities, paying it forward while also driving down our clients' tax bills. Lots of opportunity even while the markets are doing their gyrations. If you feel like your strategy hasn't kept pace or if you're not getting this kind of proactive advice, every week we set aside a bit of time to help folks we aren't already working with. If you'd like to take advantage of a quick, simple conversation to get your questions answered, I'll leave a link in the description below for you to take advantage of that offer. Remember, the goal here isn't to try to predict the unpredictable, but instead just to position yourself in a way that you can weather different market conditions and still achieve your goals. We want to keep our eyes on the horizon, not watch the waves that are sitting down at our feet. Otherwise, thanks for watching. I'll see you in the next video.